Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor. This is Dentist Money. Now, here's your host, Reese Harper.
Welcome to the Dentist Money blog on dentaleconomics.com, where we help dentists make smart financial decisions. I'm your host, Reese Harper, here with my co-host, Sir Ryan Isaac.
Hi, Reese.
Howdy, partner. How do you like our chances today? You feeling good about this show?
I am. I think it's going to be a good show, per usual. Today, we're going to talk about life insurance, which tends to raise a lot of questions.
Yeah, there's a lot of different opinions out there about the type of life insurance policy a dentist should own, how much, what kind.
Yep. We're going to do our best to set the record straight on that today. And in preparation for this, I thought I'd check to see how long life insurance has been around and what got it started in the first place.
Didn't it? I imagine it was some insurance agent that walked up to some guy and said, "Hey, I got $1 million that says you're not going to die ahead of schedule. All you got to do is take a physical and pay me a little bit of money every month."
Yeah, just place a bet, something like that. Mm-hmm. No, from what I read, it all started in ancient Rome. Actually.
Of course, as did most things in life.
There was a Roman military leader. He created a burial club among his troops. So in the event of an unexpected death of a club member, which is kind of funny, an unexpected death among troops. Yep. I thought that was interesting. But the other members would pay for the funeral expenses.
So we're looking out for the soldiers' families. Is that what's happening? So they wouldn't have to pay for it?
That would be intuitive, but not really. It actually had more to do with the fact that Romans believed anyone who was buried improperly would actually become an unhappy ghost.
Of course. Also a very good reason.
You don't want to be an unhappy ghost. Mm-mm. But the concept went away when the Roman Empire fell about 450 AD.
So you're saying that it died then?
Yes. Life insurance literally died. Okay, all right.
Just making sure I heard that
you
right.
You did. It took a while for it to come back, but there were some policies offered in England in the 1600s, and then the American colonies started doing it in the 1700s. But then a lot of the large mainstay insurance companies that we know about today, they were formed in the 1800s. New York Life, Mass Mutual, John Hancock, MetLife.
Yeah, you were telling me that some of the preachers back in the day didn't like it.
Yeah, and no, they said it was the same as gambling. I mean, it's kind of interesting, but I think most of them have come around to the idea of insurance now. So to get this conversation started, though, let's start with the amount of coverage a person should have, and then we can move on to the different types of life insurance policies.
Sounds good. This is something we spend a lot of time talking about, and it's one of the financial elements that we analyze on a regular basis is called risk rate, and we do a deep dive into our clients' risk management or insurance coverage and other types of risks. Life insurance is a big part of that, and we definitely have an opinion on how to calculate it.
Yeah, right. So there's sort of this peace of mind aspect to knowing that you have enough coverage, but there's also an economical side to it. So we've been able to save our clients a lot of money by helping them understand what is and what isn't worth paying for in their insurance. So Reese, give us a good rule of thumb for how much life insurance someone actually needs.
Okay. The amount you need is driven by your current personal spending, what you spend in a year, and your other existing assets. Some people just take a random stab at it, and other people are more precise with their calculations. In our opinion, the ideal coverage amount is whatever allows your surviving family members to maintain the lifestyle they're used to having. So that's how we calculate it.
Okay, so if you're like, I'm a poor student, or I just graduated and money's really tight, then maybe just choose a coverage amount that represents the lifestyle you would be comfortable with for your family.
Yeah, exactly. And to calculate how much you need, you take the amount of money you'd like your family to have each year and multiply it by 30. This is the total amount of assets you'd want to leave your family if you were gone. What that'll do is it basically will allow your family to have a chunk of money big enough to support the way that you want them to live or the way that you're currently living. You probably don't need this entire amount, though, because you have some existing assets. You can subtract your investments, your cash, or the amount you have in retirement plans. And if you have any real estate equity in a condo or building for your practice, you can subtract that too.
Okay, what about the value of the practice itself?
Subtracting it, I generally wouldn't count on having it because the equity can disappear really quickly depending on how long it takes to sell a practice. When someone passes away, that's the practice owner. Sometimes the practice immediately has less value. But if you have an associate or a partner that would cover and support the production for a while, then you might feel comfortable subtracting the practice equity as well. So take what you're spending, multiply it by 30, and subtract all the things that you have.
Okay.
Basically.
What about, do we count the equity in a primary residence, the home we live in?
Not unless you'd like to sell it or take out a mortgage on the equity. We generally leave out the equity in the personal residence as part of the calculation.
Okay. Well, that's helpful to know, and maybe something our listeners hadn't thought about before. So
yeah,
hopefully that was helpful to somebody. Now let's talk about the different options for life insurance. This is where it gets really broad. You have term life insurance and you have permanent life insurance, the two main categories, right? With term life, you pay a certain premium each month that's tied to a death benefit. It's pretty simple and straightforward.
Yeah, and there's term life insurance policies that you can renew every year. They go up every year, but they last for a long time. Or you can lock in a fixed rate anywhere from 5 to 30 years. The goal with term life insurance is to minimize the annual cost of the insurance by reducing the coverage you need as your assets and net worth grow. So as you get bigger and you become worth more, you reduce the amount of coverage that you need using that same calculation that we talked about earlier. So for most people, this means that by getting an annually renewable policy is the best product. It allows you to pay for only the amount of insurance you need at given points of time in your life, and it extends your ability to get life insurance for as long as possible. And I like it also because it minimizes the cost at the age you're applying for.
Yeah, by quite a bit in some cases. Okay, I'm going to ask about permanent life insurance, and before I can already see your blood boil a little bit. The vein in your neck is starting to. I know you have some strong opinions on this, and just so the folks know, when we talk about permanent life insurance, we're talking about things like whole life, universal life, equity index life, variable life insurance. Those types of life insurance policies, essentially, they combine a term life insurance product, like a death benefit, with a savings or investment account into the same product.
Yeah, and I do have a few things to say about permanent life insurance, but before all of the haters come at me, I will admit there's a few times where it's not the worst decision. So if you have one of these products, don't get all bent out of shape. Whether you should have one or not depends a lot on your situation and the insurance company that you own it with. And just let me explain so at least you have all the facts before you start tuning out. Okay?
Yeah. So one of the first ones is that you mentioned term life. It's self-explanatory. It expires. It has a term that expires. So one advantage then of permanent life insurance product is that the death benefit, like the name suggests, it is permanent.
Exactly. And when you want the death benefit to be there when you die, no matter when that is, then permanent insurance can make some sense. There's other ways to accomplish charitable giving or wealth transfer not using insurance, but that's where a lot of people use it for. They use it to pass on money to a charity, or they want to pass on money to a family or specific institutions. And so a lot of times that's the only type of insurance that can really work. And it does make sense in those situations. But I would only use that in the case for a really wealthy individual. And we'd probably define that by someone who has more than 50 times their annual spending in net worth. So, if you spend, $200,000 a year and you're worth $10 million or more, then maybe this conversation starts coming up because you're worth 50 times more than what you spend in a year. And that just means you're never really going to be able to spend all your money, and retirement's going to be very comfortable, and you're probably going to have a lot left over. So permanent insurance can start to enter the conversation for some people.
Okay. Let's talk about some of the other arguments for permanent life insurance products. You hear people talking about the guarantees or the guaranteed rates of return on these. You want to talk about that a little bit? Yeah.
So permanent, what you're referring to now, and we kind of jump to the conclusion on this, but or we said it earlier that you combine an investment component or a savings component with life insurance. And that's what Ryan's talking about here, is that the guaranteed rate of returns applying to the investment or savings component within the life insurance. And it's true, life insurance companies are in a really unique position to offer guarantees on certain types of annuities and life insurance policies. But those guarantees are only as good as the company's ability to pay them. It's just like a bond that's guaranteed by any other company like Microsoft or ExxonMobil or another large corporation. So
your point is that there are other ways to get a guaranteed rate of return?
Yeah, I wouldn't let that be the rationale for me to buy insurance because there's guarantees built into it, because there's a lot of ways to get guaranteed rates of return. Guarantees are based on the company's ability to pay those returns. And the problem is that the guaranteed return, though, always results in a lower rate of return than something that's non-guaranteed. because it costs a lot of money to put a guarantee in place, and you have to take on additional risks, right? And so most permanent life insurance policies have a guaranteed rate that's really quite low, and a non-guaranteed rate that's a lot higher. And in sales pitches, sometimes the agents will talk about the guaranteed rate of return to help people feel comfortable, but then they'll really be showing or illustrating non-guaranteed rates. So if you look at like a life insurance illustration, you'll see two columns, and one will have like a guaranteed rate and one will have a non-guaranteed rate. And just know that the non-guaranteed rates of return, they're just best estimates. They're projections, just like you could do on any investment that you have, any bond or any guaranteed investment product.
Okay. Another argument for permanent life insurance that you hear is that you're saving money instead of spending it, right, on term.
Premium, like wasting money.
You're wasting it. So a lot of times agents will refer to this as renting versus buying your insurance policy.
Yeah, and my response to that is that buying permanent life insurance doesn't mean you're saving money on the insurance costs. That there's costs inside of the policy that you can't see, the permanent life insurance policy, and those costs they're buried inside of your monthly premium. But the product's sold as if there are no costs, like all of your premiums going right into the savings account inside of the policy, which isn't the case. There's a lot of costs that are inside of there.
Yeah, and that sometimes is misconstrued as well, where agents will want you to think that your entire premium, and maybe not just agents, but people's understanding is that your whole premium that you pay is added to your savings or investment account portion of the insurance policy every month. And that's just not the case.
In reality, there are actual additional hard costs that insurance companies have to pay to insure you with a permanent policy beyond what term insurance costs.
What are some of those expenses in these policies?
It's a super long list, but we could start by just saying there's commissions that are different, and there are higher amounts of commission to sell those types of policies. They are more complicated to explain, and insurance carriers pay a higher commission to agents to sell those because they take more effort. I mean, it is a product that, for whatever reason, the commissions are higher. That's a best case kind of explanation. I think at some level you could be cynical and say the commissions are a lot higher because the costs get buried easier, and it's easier to just say, we can sell more of these, and, it's not as easy for consumers to digest the costs and the premium. And so there's commissions that are very expensive. There's benefit programs they have to pay for, like the insurance agents work for agencies and brokerages, and those brokerages have benefit programs. And so the life insurance companies will pay more to help support those sales efforts. A lot of the cost has to do with sales initiatives. But then there's special state premium taxes that, like if you pay a permanent life insurance premium in the state of Utah, the last illustration I saw was a 2.25% tax on your premium. Now, you don't really see that because the insurance company just takes the money and pays the state premium taxes, but it's a cost. I mean, that's more than like a mutual fund in a lot of cases. And so there's maybe one other cost to think about is that these state premium taxes really do add up over decades, So you don't have to pay those, and life insurance companies don't have to pay those for term insurance contracts.
Okay. What about the cost of the insurance itself inside of the policy? Are the cost of a permanent life insurance policy, are they the same as the cost of a term life insurance policy?
The cost of insurance, they call that the COI sometimes. It really depends on the policy and the carrier. For whole life, the costs of insurance are a lot higher than those of term insurance, especially initially. They're kind of like, whole life is kind of like a level term. The cost of insurance is kind of like a level term policy that lasts forever. I mean, out till your assumed death or the endowment point. There's like a point in the life insurance policy where eventually it matures, and that's usually out into age 100 or something like that. And so you're overpaying today to lock in a cost of insurance that'll stay fixed forever, where if you just paid the cost of the annually renewable term, it might be 5% of the cost or something.
Right.
And so it just depends on the carrier. For whole life, it's like that way, and for universal life or variable life, the costs slowly rise over time, and sometimes they're very similar to the cost of term, but in some cases they're a lot more. It just depends on the carrier and if they have a field force or an agency to support, or there's some carriers that don't, and so those costs resemble term insurance really closely.
Okay. You hear the argument a lot that permanent life insurance offers a tax-free income when you reach retirement as one of the. I mean, that's the selling point I probably hear the most about is the tax-free retirement, right? You want to talk about this a little bit?
Yeah, that's true. I mean, there is an opportunity to get tax-free withdrawals out of a life insurance policy. They're actually loans that you can take out of your policy as you get to a point where you need them. It's a possibility, but it's not a reality for most people. At first blush, it sounds really appealing for obvious reasons, but in order for the person to be able to borrow money against their policy tax-free, a lot of things have to go right, and these vary a lot from company to company. So I always tell people before they pursue this strategy, try to go find someone else who's doing this right now in retirement, someone who's living in retirement on tax-free income from an insurance policy, and see how happy they are with their situation. And from my perspective, just anecdotally, as a financial advisor who's having conversations with hundreds, even maybe thousands of people over the years, the ratio of people that think they're going to do it, who actually do it. I mean, I have to say, for every 100 people that tell me they're going to do it, I find one person
that's actually pulled it off,
that's actually doing it. And but you'll see real estate investors who are living happily on rental income. You hear that a lot. I can build up rentals and then live on that.
But then
income.
You see that, yeah,
you see it happening pretty frequently, and so that might be a reality for some people. I've met a lot of mutual fund investors who are living happily on dividends and interest income. I think you've seen that a lot. I've seen that a lot. Business owners who are living off the profit of their company, or a dentist who's living off the profit of a few locations. I mean, I've seen all those kind of things, and I see that regularly,
frequently. Yeah, it's not uncommon.
Yeah, for every 10 people that employ it, maybe there's one or two that are actually pulling it off. But I've never met a permanent life insurance I don't want to say never, but I rarely meet permanent life insurance policyholders who have said, this worked exactly like I thought it was going to.
Okay, so then the big question everyone's thinking is, why doesn't this strategy pan out the way it's proposed? Yeah,
I mean, I feel like expenses have a lot to do with it. Yeah, it's very expensive. There's a very long, what we call break-even period. And the third thing is probably just natural life events that occur, right? During the first 20 years of your career, most of us have a lot of income fluctuations. We have a lot of need for flexibility with our investment portfolio, and most life insurance policies do not offer flexibility, even if someone tells you it does, right? And whole life policies, they require a fixed premium payment. If you miss premium payments, the policy can start to eat into cash and run out of money quite easily. And we have life events that come up, that require liquidity. And most people that employ these strategies, they haven't thought through it quite carefully enough, so they end up overcommitting to funding their policies. In a best case scenario, what you'll see happening is, someone does plan effectively and doesn't quite overcommit. They just do a little bit. And then at the end of the day, usually what they end up doing is keeping their policies and passing them on to charity and doing wealth transfer. But I just feel like with the whole life policies, it's a fixed payment and it's hard for people to stick with. And when they need cash, they slow down or borrow against it, and they start borrowing money out at too early of an age. And with the variable or universal policies, even though they offer flexible premium payments, meaning they'll have a minimum payment, but then they'll have the one that they ask you to pay. It's not as flexible as you think, even though the premium payment might be flexible, because you have to put a lot of money into it in the early years and not mess with it so that it can get to a point where it supports all the costs that are in the policy. And so these products have a ton of moving parts, and it's not as easy to successfully manage the interest you owe to the insurance company, because when you borrow the money out, you owe them interest. And then you've got to calculate the right amount to borrow and know how much you need to accumulate in the policy to successfully fund your income goals. And so it's just a really complicated picture. And after me explaining this 3 or 4 times in the last 5 minutes, I'm just thinking now I know why a lot of people just end up getting confused, right?
Okay, now you mentioned something about your investment inside these policies breaking even.
Yeah.
It kind of takes quite a while to get to the point where you even have a positive return inside of these. And
Yeah.
and I think that's a huge misconception. People believe right off the bat. You'll probably touch on this when they're quoted. Things like the rate of return or crediting rates.
Totally.
They assume that day one they're getting this guaranteed rate of return and their investment's protected and growing right from day one, but it takes a while.
You're right, man. Yeah, and it's probably one of the most negative aspects of these kind of policies that if you've ever purchased one, you know that there's a lot of expenses in the first 10 or more years, and you have surrender penalties, which will take away money if you take anything out, or you can have a really large upfront cost, and so you'll put a lot of money in and you won't see anything in your savings account. And it's essentially the same thing in my mind. I'm amazed at how many people are like, it's not really that expensive. I can see all my money in my policy right when I put it in. But then there's a surrender charge that if they take the money out, they lose all their cash.
Yeah, it's like gone.
It's no matter what, folks, if you pay a lot of expenses and a commission up front so that your cash is at zero, or if you pay a big surrender penalty, it's the same thing, and I think it's important to remember that.
Okay. Another big advantage that people talk about is borrowing money against a life insurance policy. That's another big reason why people actually buy these policies. But aren't there other and less expensive ways to actually borrow money?
Yeah, it's a good point. And borrowing against an investment isn't something that's exclusive to life insurance policies.
Big misconception, though.
Yeah. Big misconception. Life insurance policies are that's an asset you can borrow against, but there's you can get margin loans or loans against your bank accounts, against mutual funds, bonds. I mean, a lot of your investments, you have the ability to borrow against them, and they're just simply a loan from the bank that holds the money, and they allow you to borrow against your investment portfolio, just like a life insurance company will. And similar to the life insurance policy, you're not going to have to pay income taxes on the money you borrow. When you borrow money against an asset, the asset keeps growing and it stays in the account, but you got to pay interest on it. Margin loans are just a lot less expensive. They don't have as high of interest rates as what you'll usually find inside of life insurance policies.
Okay, a couple more things as we start to wrap this up here. Proponents of permanent life insurance also talk about the protection your investments have against creditors when it's inside of a permanent life insurance policy.
Yeah, and I think that's something that is probably a little bit of a misnomer. I mean, I wouldn't buy a life insurance policy just out of creditor protection. I mean, your qualified retirement plans like your 401k have really strong asset protection, and creditor protections, and a lot of wealthy families will use liability insurance or trusts or corporations to protect their assets, and so creditor protection isn't a good enough reason, in my opinion, to invest in permanent life insurance.
Okay. Another thing you'll hear is this argument that your 401k is a risky investment and the stock market is rigged, so therefore, buy the insurance.
Yeah, and this is a really commonly repeated myth. 401ks are evil and, life insurance is safe. And 401ks are just an account type. Remember that. They're not an investment. So the investments inside of your 401k are completely within your control to select. You can buy a conservative investment, almost identical to what you're going to find inside of a life insurance product. You can buy corporate bonds or leave it in money market or keep it in cash. And all this can be part of your 401k, right? And your 401k is just an account, and it's not risky or conservative. It's up to you to decide how much risk or how much up and down movement you want in your 401k.
Yeah, and you've talked a lot about this in other podcasts. You're touching on the same thing. A big misunderstanding is that investors believe all of their investments are in the stock market, but financial markets aren't stock markets. You can, like you said, buy bonds, money markets. You can do a lot of different things, which are the same things you can purchase inside of insurance too.
Yeah, I mean, it's important to separate in your mind the difference between investments and the accounts that you're actually investing in. It's just a matter of knowing how to properly build and diversify your portfolio.
Okay. Well, let's wrap this up. Bring us home here. Offer the listeners some parting words of advice to ponder about life insurance.
Let's hit three of them. First, permanent life insurance is optional. Okay, it doesn't offer significant advantages over term insurance for most people. All right, and it's a very small percentage of the population and very small percentage of circumstances that need to consider this. And for the most part, it's oversold and it's over promoted. and it's sold to the wrong market. Okay. So the second thing to remember is using permanent life insurance as a savings vehicle, a place to invest for retirement, has major implications on your personal financial plan. And you shouldn't be getting advice strictly from an insurance agent who's paid on the amount of premium that you pay into the policy. You've got to consult a financial advisor or someone else who you trust, an advisor you trust, who has a more comprehensive, in-depth understanding of your overall tax situation, your estate situation, your investment portfolio, and your debt reduction plan. And getting tax-free income from a policy isn't it's not a good enough reason to invest. You can get the same benefit with less complexity using a broadly diversified investment portfolio. That's
Okay.
number 2.
One more.
The third one I'd say is that compensation that people receive for selling permanent life insurance policies is very high, and it can make even the most well-intentioned people oversell you. So even your best friend from high school, okay, even your father-in-law,
he's a good
all
guy.
right? Even your brother, your twin cousin.
Yeah.
Okay.
Twin cousins.
So you've got to get advice from someone who isn't getting paid to sell you a policy. And I'm worried that too many people, they don't own enough insurance, but they're spending a lot of money on insurance types that they might not need. This is one of them, and I'd rather see people have the right amount of life insurance than try to stretch their budget and force permanent insurance to fit and then cut their disability insurance short or, not fund something else. So to all my agent friends out there, you know that I believe this, but a few of you are doing a really, really great job. And there are too many insurance agents that are not providing the right kind of insurance advice, and permanent insurance end up getting used by too many people that don't have any business owning it.
Okay, there you have it, folks. The man speaks truth.
I felt like that was a mouthful we tried to plow through.
It did. It's an important one. Well, thanks for listening. Thanks for joining us. We hope you'll take some time to give us some feedback on this. If you go to our website, dentistadvisors.com, at the top there's a little tab called Listen. You can use the comment section for this episode to ask questions or give us feedback. We'd love to hear from you. When you're on the website, you can also schedule a free consultation if you have any questions. And don't forget to visit us on Facebook, right? Dentist Advisors Facebook page. You can keep tabs on us and see all the very exciting things that we're doing.
Facebook. Carry on, folks.